Investing Amid Low Expected Returns by Antti Ilmanen. There has been a shift among investors from actively selecting stocks to passive investing. Welcome to yourbooksummary.com. In recent decades, low-cost index funds, especially exchange-traded funds, have become wildly popular. Instead of attempting to pick individual stocks or hiring managers to select stocks, investors increasingly have turned to letting an index do the work for them. According to Morningstar, in 2007, passively managed mutual funds accounted for 19% of the market share. By 2021, that percentage had risen to 50%. The tide toward index-based investing is partly based on the reality that active managers struggle to pick winners at a pace that justifies their fees. While certain active managers can claim some credit for their winning investments, passive investors' reliance on broader trends cannot be ignored. Even Warren Buffett, a highly successful value investor, owes a significant portion of his market-beating performance to market exposure rather than his intelligent investment strategies. Similarly, George Soros' quantum fund benefited primarily from market exposure during rising asset values rather than his unique investment approach. Investors may have taken the low-fee approach of passive investing too far. Instead of focusing solely on minimizing fees, investors should prioritize maximizing returns. While there has been a broad shift towards index funds, the growth of hedge funds and private equity funds managed by active managers has somewhat offset this trend. Even though management fees have generally decreased, top hedge fund managers still command fees of 2% of assets and 20% of performance. In comparison, passively run funds typically charge less than 30 basis points, while actively managed stock funds can impose fees of 30 to 80 basis points. I hope you found the information about the new case for gold by James Rickards. If you're interested in learning more about the book, stay tuned for the next part of this series where we'll dive into the next section. Thanks again for watching, and I'll see you in the next video.